Hi everyone, this is Paul Lang from DTS, and I want to introduce you to what you're about to watch. This is an hour-long event that was presented live to the free members at Disciplined Trading Strategies. This is called Upward and Downward Spirals and discusses a problem you've likely encountered if you've ever been trading before, or one you likely will encounter if you're beginning trading. If you ever had a good trading streak suddenly collapse, or a rough stretch quietly snowball into worse decisions, this session will show you why that happens and how to recognize it and deal with it. If you enjoy this, check out the many other full videos of educational events, articles, and Trade of the Week videos you can get access to at the DTS Free subpage. For now, sit back and enjoy this event. Good afternoon, everybody. Howdy, hey, howdy, hi, heydy, hey, ho. Sound is good. We're all set to go. All right, welcome to tonight. I haven't done one of these specifically. I know some of you probably get confused. What's the difference? You're here meeting, we're talking, but there's a Monday night scanning sessions that are every other Monday. Those are not recorded. And then I pretty much gone on the schedule of doing the first or second Wednesday of the month. I do a full hour-long special event on various educational events. I've done I think there's 130 of them on the Platinum page now, tons of them. Impromptu, yeah, the impromptu is just like the educational event, except it's kind of not on the calendar, 1 or 2 days notice, and it's just like the email says, it is too much for an email and not enough for a full presentation. And this actually was going to be an email. Somebody asked me about this topic on the last presentation I did because I brought it up. And it is a unique and odd topic, sort of, and it would be hard to explain in an email. And it is almost hard to explain in person. It's the reverse of Nike, just don't do it. And a lot of this topic is kind of like that. There's nothing intrinsically new or difficult about this topic, yet it's something that I imagine ends a lot of careers because people just aren't aware of it. So a lot of this is awareness, understanding it. The cure for it is nothing astounding. You're not going to go, wow, my glad Paul said that, but you may be happy you saw the whole presentation. So let's begin. This is called upward and downward spirals. I talk about this a lot. I refer to this a lot. I mentioned the seminar program. I say what it is, but how to identify how does it happen, why does it happen, and what exactly is it in case you're not real sure. Opening slide, just a cute slide, nothing else to say. First concept to understand. To me, there's 2 or 3 things you have to understand, and then I'm going to explain it, and I'm going to give you a couple examples of how it happens to me, and we're going to be done in 30 minutes because that's what the promise is. There are only 2 times when psychology affects you. And some of you know what those 2 times are. Anybody know what the 2 times are? Anybody want to take a guess what the 2 times are? Only 2 times. This is a good thing about trading. There's only 2 times when psychology affects you. Yeah. No, when you when you win and when you lose. Those are the only 2 times, right? Yeah, that's about it. When you win, I'm sure you have experienced this, the feeling that you're like a trading god now, and you like the feeling of making money, and you just got to duplicate that again and make more money and keep it going. But of course, you're neglecting the fact that what you did properly to make money on that trade or those first couple trades is probably what you're not going to do when you get greedy and just go chasing the third one. It's patience, taking the best trade you can find, waiting for the right moment. And if you get overly excited and you think you're just incredible, you tend to take a lower quality trade and it doesn't work. Anybody experience this feeling? I mean, if you're trading, I'm sure you have. If you've had one winning trade, you probably experienced this, right? And it usually is very much to your detriment. You may get another trade and then all of a sudden you get back part of your winnings, and then you may go on to experience the feeling that, boy, I was up X amount of dollars, I'd kind of like to get back to that. So then you start taking more trades to get back what you lost, and then pretty soon you're negative on the day, right? Not hard to envision. You've probably done it before. So there's one concept to keep in mind, that psychology can affect you when you win. When you lose, of course, everybody knows that feeling, how psychology affects you. When you're down for the week as a swing trader, for the month as a long term, when you're down for the day as a day trader, what is your one goal in mind? What is absolutely burning furiously? Yeah, erase the red. Yeah, get it back. Erase the red on the screen, right? And to do that, we just start taking trades faster than ever just to get rid of that red as quickly as we can, as if it's something that, is going to get, as if the red was going to grow if we didn't do something about it. And obviously that is the wrong thing to do as well. The second concept to understand, and boy, you wouldn't believe how long I worked You wouldn't believe how long I worked on this slide, which to me it was a big deal, choosing the right word. And I had a different word here. I ended up going with to trade right, you have to be extremely confident. And I went with a different word. I looked up the word. I kind of liked it. I don't think it got across the right meaning. You have to be extremely confident to trade properly. And this is the part where a lot of you may not get this. You have to be at a level beyond confident, and I think it's important to say that. The difference between confidence and really confident is important. But then there's that fine line you don't want to step over where you get arrogant and careless. Why do you have to be so confident? Well, the reason is because even at our best, we don't necessarily have the greatest odds. I'm going to get to that in just a second here. Confident trader trusts the process, not the outcome, knows trades can lose and plans for it, follows rules even after a winning streak, thinks this setup has good odds. What's the problem with the first line for probably a lot of people listening to me and for anybody starting off? Trust the process, not the outcome. What's the problem with that line? Because it is probably the most important line on that little fake chalkboard. What's the problem though? There's a very obvious problem with that line. No, not really what I'm getting at though. I mean, if you believe in that line, then I'm not sure goes against wanting to be right because you'd want to, being right means you'd want to trust the process. But what's the problem? Yeah, Glenn hit the closest there is that somebody newer can't trust the process because they haven't experienced or don't really know what it is, right? If somebody told you, here comes a tornado, go stand next to that trailer house about 10 feet away from it and just stand there, you'll be safe. I mean, if for some reason that was the right thing to do, it might be the right thing to do, but you probably wouldn't do it because it just doesn't seem right. And a lot of trading is like that. I mean, people, when they're new, don't know the process, they can't trust it, so they're always, trying to finagle a different way to do something. And that is part of what starts this whole spiral process. But let's keep going here for a minute. I've said this before, and I want to reemphasize it, and I don't mean to scare you if you're new or wanting to learn or trying to learn. But even for the best trader, the odds are not great. And what I mean is when I look at like just what I consider to be a great trade, I don't know how you rate a trade. I mean, you can't, it's hard to say it's an 80% trade because I mean, what does that mean? You made 3 cents on the trade? I mean, but I mean, just if you were to just kind of grade something and just say that the chance of getting to a good target, to my target, to make good money, whatever it is, just a soft definition. I mean, you just don't get to those 90, 100% things when you're looking at a trade. Everything is just, okay, that's pretty good odds, but you have to keep in mind anything can happen. The example I like to use is if you owned a casino or if the casino let you own a table, right? If you owned a table in Vegas, would you want to run the table? Anybody? You probably don't have to be a gambler or an expert at Vegas, or would you? In other words, being the house, does that make money in Vegas? Yeah, it sure does. But anybody know the odds of blackjack, for example? Anybody know the odds in blackjack for the house? Yeah, it's 52.48 approximately. Yeah, 52.48. That's not huge odds, right? And my point is that to keep the 52.48 odds, they have to do everything perfect. So in other words, if you came in and you bought a table, say they gave you a table to run, so you're the house, and you're running your table. Okay, you have 52.48 odds, but what if you decide to get cheap about the whole thing and you don't have a camera system at your table, you don't have the right security, and then people start cheating and they're whatever. By the way, do you see that special on? There was a special recently about the new high-tech ways of cheating in Vegas and all this stuff, just amazing. But anyways, you don't catch all this stuff, right? Well, your odds slip and you're losing money. It's kind of like that in trading. To exaggerate it a little bit, just like in Vegas, owning a table, you have to be perfect to get those 52% odds. Do you understand my point? So it's not the same odds, it's not the same thing, but you have to be really strict and good to maintain your edge in trading. You can't just be sloppy. And any little thing can throw you off balance. So with that background, again, this is a foggy topic, I'll admit it. With that background, upward and downward spiral, to put it simply, you take a trade, it makes money. You proceed with trade 2, and it makes a little money. You see your next trade. It's aggressive, asterisk, asterisk. Generally, when I say aggressive, I mean something that maybe is a little lower odds of being right, but maybe more in the home run category if it is right. and you feel you normally don't like the aggressive trades, but you have a little money to burn, so you go after it. It becomes a home run. You have a cleanup day or a cleanup week or a cleanup month, whatever that is. Can you relate to that slide, everybody? Do you kind of get it when I say it like that? I mean, this very much affects me, and I'm not even sure on some of this if that's good or bad. There's a limit. On one hand, you're following a plan, you're trading objectively, but on the other hand, part of the objective process for me, what I like to do, like in any time frame, but take day trading for an example, I like to start off kind of conservative, maybe build up a little bank, and then take a more aggressive trade or two, kind of, use the house's money, so to speak, to, you know, move it up. And the opposite of that would be if I have a tough morning, I don't want to go crazy and dig a big hole. So I want to get more conservative. I can see an argument against that in both directions, but combining your chart reading ability with money management, chart management, I think that's where you should end up. So the upward spiral, you do well, it gives you confidence, it gives you some money that gives you more confidence, and you get very aggressive on the next trade. Oh, I didn't put a chart in here I want to put in here. So you get very aggressive on the next trade. Trading aggressively is how you make money once you know what you're doing. Being careful, being conservative, generally speaking, is not the way to go, and you'll lose money doing that. That may be very backwards to some of you. It may be because you don't fully understand what I mean by aggressive and conservative. It may be because you're just not there yet. But basically what I'm saying is there is a moment when the trade is perfect, and when the trade is perfect, it's oftentimes the scariest moment to enter it. Because we're all lemmings at heart, we all want to follow somebody else. We don't want to short at the very, very, very high of this run, the high of the day, because nobody's shorting yet, nobody's selling. Seems like the stupidest thing to do, but yet all of a sudden the stock drops a lot, and now you're taking a secondary entry. Does that make sense at all, that line? And this is something I have paid very much attention to for a long time, and I have to tell you it's 100% right. I mean, anytime that I back off a little bit, and for some reason I say, okay, I'm just going to, hold off of that, it's always the wrong thing to do. It's just almost always the wrong thing to do. I put two charts in here, and I have to decide. I may have to take you live and show you a chart from today, or maybe I'll just tell you what it is and you go look yourself. I don't know how I forgot that chart because it was the original chart I thought of to put in here. So you're very happy, and it's just a process that builds on itself. The more you make, the more of a little bank you have, kind of the more aggressive you get, the better you trade. It just spirals like that. It's just the way it goes. But now look at it the other way. Compare it the other way. You take a trade that loses money. You proceed with trade two, but you really don't want to lose, so you quickly tighten the stop. Sound familiar? You're down money, you start getting cheap, right? It stops out for a smaller loss, and then you see it take off, and it would have made lots of money. You see your next trade. Now you're super careful, you don't want to lose. So you wait for a super conforming entry. It's so late that it is never very green. You may not see this in yourself. Have some of you seen this in yourself? This is the one that's hard to see, because a part of you will feel like you're doing the right thing because you're being conservative, you're being careful, you're being cautious. It doesn't work in trading. Now, again, there's that fine line. I'm not promoting that you should be reckless. You have to know what you're doing, but when you know what you're doing, and when you watch, I've said sometimes, I put this in presentations or in an ad for the room, I said, if you're newer to trading, or if you've been trading a while, and you came to the trading room with me, you probably would know what the heck I'm doing. You'd be like, what's this guy doing? This makes no sense at all. Because I'm not doing what people traditionally do. We have to learn what you're doing, and when you do, being super aggressive, here's the thing. The most aggressive trade, the most aggressive entry, you're still losing your one risk unit at worst, right? You can take the most conservative trade in the world. You're still going to lose your one risk unit if you're wrong. The super aggressive entry makes you lots of money when you're right. And there's this fine line in between, which is really today's trade I wanted to put in here for you, is an example. Well, let me tell you what it was, because I don't know if we're going to get to it. Now I got to back up and talk about McDonald's days. What was this short today, guys? You can't trade scared. That's exactly right. It's exactly one of the phrases I was going to say. What was my short today, for crying out loud? PayPal. I said it before I saw you type it. So let me explain this to you. And if you have charts up, pull up PayPal. PayPal today, I shorted under 41.49. To me, it was about as aggressive as I could get. If you look at PayPal, It was just, it ran up today and it was like at 9:45 or something. It was just coming off the high of the day and I shorted it. Now, PayPal only ended up making like a half of a risk unit. But here's the thing, if you waited for a conservative entry, traditional entry, you would have stopped out. The way I read the chart. And I didn't put this slide in here, I apologize, but just note PayPal, I shorted it under 41.50, made half an hour covering it around 1 o'clock. Yeah, around 1 o'clock, and then at 1:30 trailed out the rest of it. So it made some money. But here's the other part of this that's really not directly in this presentation, but I find that for most people, this formula is kind of what works for most good traders, and it applies to long-term swing trading, day trading, take day trading. I find that most weeks or most days, it applies to the week, it applies to that. It's like an 80-20 rule. But I typically find on a good day that you usually have, let's say you take 4 trades. I've been taking 3 on a day or 2 to 3. But let's say you take 4 trades. Typically, I think you're going to have like a decent winner, a small winner, a small loser, a McDonald's trade. A McDonald's meaning just kind of a nothing trade. The important thing that, and for a week, typically what people, good traders end up with is a really nice winning day one day, an okay winning day one day, maybe a moderate losing day one day, what you should have, and a couple of McDonald's days, meaning just kind of like today's McDonald's is plus or minus a half of an hour, just a nothing day. Those McDonald's days are the ones you need to focus on. Those are the problem days for most people. Everybody has losing days, everybody has winning days. It's the days where you just couldn't pull something out that people try and push those. And this is a good example where while the PayPal trade was not a big winner, it was a half-hour winner rather than a full loser. I think anybody trading it under traditional style would have had a full loser. And that's a 1.5 hour swing, which is huge. And that's what you have to look at. So it's not that every decision makes you tons of money. Some of the decisions make you a little money rather than losing money, or some have you break even rather than lose money, or some have you lose a little money rather than a lot of money. It all adds up tremendously. Take your next trade. Now you're super careful. You can't trade chicken. And you can see how this continues on. The more you trade poorly, then the more you lose, and the more it encourages you to trade poorly, because trading poorly is trading chicken, trading conservatively. There is no way to trade safely. Not that simple though. There's a fine line here, and this next talk, applies to me as well. Now remember on the upward spiral that you can blow it because there's a difference between super confident, yes, and being reckless, no. Remember my opening comments. Sometimes you have psych issues when you win. When you win is won. So yes, upward spiral is great as long as you're always doing what you're supposed to be doing. Trading aggressively is what you should be doing. It should be defined. It should be how you trade. I think most of you, especially if you're in a seminar program, you know what I'm talking about. But you have to follow what you do. You can't just all of a sudden then break the mold and go, okay, now I've made so much money, I'm just going to go crazy with this, and then you give it all back. You have to trade exactly like you're supposed to. Not recklessly, but super aggressive, super confident. Does that make sense, or am I losing you? Just say losing me and I'll try and re-explain something if I can. It's a tough topic, I have to be honest. Does this make sense so far? We're not done yet. And this is where at the end of this, I'm going to give you my closing slide comments. Like I said, it's kind of like, don't do drugs. It's kind of like, how many ways can you explain it? Sounds simple, yes it is, but that doesn't mean you recognize it. It's a very psychological topic. You will never not do it. I still do. But I recognize it, and that is step one. Now, that's an important slide here. This is a very psychological topic. You will never not do it, intentionally phrased that way. Sometimes double negatives are not always the same as the positive. You will never not do it. You'll never stop doing this because there is a balancing act that I'm going to go into in the next slide, that it's almost impossible to draw the line in the sand between proper management and being overly cautious. And I cross that line frequently to my regret, but I'm always monitoring it. And here's the big thing. This whole thing I'm talking about, every word I just said in the slide, most people probably don't even know what I'm talking about, don't even understand. So when I say it, I'm talking about getting into this upward or downward spiral. This then can carry on from day to day, from week to week, month to month, and it grows the longer it continues. Small decisions tend to snowball. It's even effective in me to the extent, and I haven't actually tracked this as a formal thing, but I just know that as a day trader, if I start off with a losing trade, I'm less likely to have a winning day. And I mean, even despite being down the losing trade. If you just say, okay, Paul, here's a losing trade. Let's pretend you're starting from zero. How's your day going to go? I know when I start with a losing trade, I'm not going to have as good of a day from that point forward. It affects me a little bit sometimes. It shouldn't. Well, excuse me. I shouldn't say it shouldn't. It maybe should. And that's what I want to get into next. So there's another fine line here. Managing the account may conflict with managing a trade. Can anybody, what am I talking about here? Managing account may conflict with managing a trade. That is not an easy area. What does that mean even? And I put the word may. What does that mean to manage the account conflicting with managing a trade? Here's what it means. Ford from Tuesday. I'm not putting any numbers on here. It doesn't matter. It's a point here of what happened psychologically. I got in Ford right down there, right off the bottom. I think it was at point 96. Just right off the bottom, 2 cents out of it. Great entry, okay? Because of that great entry, that aggressive entry, because of that super aggressive entry, I was up 1 hour at that top. My decision was that I felt Ford had much more potential. I felt it was going to go up to 14.20 or something. So I decided to not sell any of it. Now, backdrop to that, my first trade was struggling at that time. I ended up closing the first trade down a half of an hour. And I had a second trade in place that was struggling. Now, at the time, I knew my first trade had already capped it to a 1/2 hour. So I already had a potential 1.5 hour loss on the first 2 trades. They weren't out yet, but you know, that potential was there. So when I took Ford, I really liked Ford a lot, but I was kind of, you know, a little beyond where I'd like to be. I really don't want to have a morning where I could drop 2.5 hour in the morning. You know, I don't want to do that. I took this one because I knew the one stop was coming up. I knew that also Ford I could manage in a way that maybe wouldn't lose. But anyways, the point is, then when I got up to here, I didn't take any profit because I really wanted to take this up to 14.20 or something. So what I did was I had this little base form here and I decided, hey, I'm up here. I'm going to raise the stop to the bottom of that base. And by doing that, that locked in some profit on Ford. Not a lot, a quarter of an hour or something. But at least it was green. Yay. Well, guess what? It stopped out by 1 penny. 1 penny. Now I teach a lot. That shouldn't happen to you. It's always, you can't help it happening to you sometimes. It's always going to happen. But that's not something that should happen often, right? And that you can't read that trophy. It says Idiot of the Year award. Kind of felt like that. And Ford went on to get, you know, pretty much to my target. Ford was up 2 days profit at the high here, and I got out with a small profit. Now, why did I do that? Managing the chart the way I managed, that was the wrong decision. Why did I do that? Why did I do that? I was managing the account. And it probably, yeah, and it wasn't right to do that in one sense. On one hand, manage every trade exactly like it should. Don't screw up a trade for the benefit of another trade or for the account. So either just bite the bullet and take the loss if that's what it's going to be, or don't take the trade. Does that sound like a good comment? Is that the right choice? Does that sound like good logic, what I just said? And doing that, of course, would make this a mistake. You look at that chart, I mean, you got to say, if somebody showed me a chart, I'd say, well, you're just an idiot trader. You should never do that. So do you agree with that comment? Manage the chart and don't ever reflect back on the account. If you decided to take the trade, you got to bite the bullet on whatever your loss you have, right? In an ideal world. Here's the other side of that equation, though. I know I made it sound like that's the right answer, but here's the other side of the story. It wasn't quite that simple. I really kind of was willing to do that with Ford. Well, yeah, true tag. I would have felt good, but that's not really relevant, right? Your after the fact emotions have nothing to do with how you manage your trade. At the end of the day, you can always look back and do the woulda, coulda, shoulda thing. But the point is, at this moment in time, was it the right thing to do? I entered down here. I was green this whole time. Wasn't the thing to do really for everything that was going on. But here's the other part of the story you don't know, which is going to make this even more confusing to you. As we were pulling back here on Ford, guess what I was doing? I was looking at a whole bunch of trades I really liked. Dum dum dum. So now we have a more complex problem. That on this day, at this point in time now, when Ford was here, I was down 1.5 on my first 2 trades. Ford, if I didn't move the stop, was eligible for a full loss. And here's the thing, I wanted another trade. and I ended up taking the market long. So the market long did great. I ended up I was thinking of holding this overnight, so I gave back some profit. But the market trade was up 2 hours, and I wouldn't have taken the market trade if I didn't cap forward, because there's no way I wanted to have a 3.5 risk on the table. So now all of a sudden you're back and you say, oh, capping one trade in order to take another trade that makes money, maybe that does make sense. That was a great trade. I probably wouldn't have taken it if I didn't raise Ford. Now it turned out they both were winners. But if Ford tanked and the market tanked, I would have had my worst day in months. So what's the right answer? It's a tough call. I mean, it really is. But I want you to be aware of all these things and get to a level where you understand, how this spiral can happen. Bottom line, none of this probably would have even been an issue. I would have had Ford and this one if I didn't start off with a loss that day. Should that have changed how I managed the other trades? On one hand, I'd say absolutely not. That's probably the right answer. But you have this thing that you have to decide during the day is, okay, does balancing act here? And a lot of times, I'll cap something so I can take another trade. That next trade's a home run, and the one I cap works also. It held there. And then you feel like a superhero. But then sometimes the one you cap, just like this, works bad, and the one you get into maybe doesn't work, and now you feel like a real idiot. Here, everything worked, but I was out of Ford because I raised the stop on it. Does that make sense? Fine line between good decision and emotional one can make it hard to distinguish and make this often a silent, overlooked issue. The best thing I can tell you on this is to understand and be aware of all that I said. And I know some of you, a couple of people expressed a big interest in this downward spiral thing. It's hard to break because you just have to draw a line and say, hey, the answer to this is simple. Number one is awareness. It's seeing that you're doing that. It's seeing that you're trading differently because you've been losing. I go back to the same opening comments though. If you're a new trader, and this is why being a new trader without training is so very hard, because how do you know you should continue to trade aggressively if you had a couple losing trades, if you're not even sure you're trading properly in the first place? But once you're a successful trader, confident trader, my attitude is if I have a couple losing trades, you know what my attitude is? That just means I'm going to have a bunch of winning trades coming up. That's how I look at it. Not everybody can do that. So awareness is really key to see that you're trading differently because you're winning or because you're losing, and that different way you're trading is affecting you. Everybody understand that comment? It's probably the number one most important thing to do. It comes from tracking what you do. So you go back and look at what you did, and you understand that you didn't manage or you didn't enter something the way you normally should have. You realize the reason I did that was because I made a bunch of money yesterday or I lost a bunch of money yesterday, whatever it is. And it changed what I should do. You can't change what you do. Were you allowed to make that change or not? Understand confidence comes first. High level of confidence needed to trade. You have to learn how to trade to get confidence. 90% of issues are not psych. I want to remind you of all that too. Something I've harped on a lot this last year is that 95% of the time people come to me and they say they have a psych problem. They don't have a psych problem. They have a basic technical analysis chart reading problem. Nobody can trade properly if you don't know how to read a chart. You'll always blame it on psych. Once you've learned everything, then possibly that's when psych comes in. The antidote to all psychological problems is a properly executed trading plan, which along with incremental risk progression is what builds confidence. You build confidence by learning, by trading, by improving what you're doing and being able to trade and trade aggressively because you're not risking so much money in the beginning that it's freaking you out. Questions? That is a quick impromptu session on a single topic. Thank you for the feedback. Neil, I agree. Any other comments? Feel free to email anybody if you have any questions. Have a great night. Trading with people in the morning, seminar program Saturday, and then next week I don't know what's up. I'm sure you get emails. Have a great night.